Hello and welcome to our finance and investment focused channel, where we aim to empower you with knowledge to make informed financial decisions. Today, we're diving into a topic that's crucial for both seasoned investors and those just starting out: how to build a strong investment portfolio from scratch. Whether you're planning for retirement, saving for a big purchase, or simply looking to grow your wealth, understanding the fundamentals of building a solid investment portfolio is key. So, grab a notebook, and let's embark on this financial journey together. What is an investment portfolio? First things first, let's define what an investment portfolio actually is. An investment portfolio is essentially a collection of assets owned by an investor. These assets can range from stocks, bonds, mutual funds, and ETFs, to real estate and even cryptocurrencies. The idea is to diversify your investments to reduce risk and increase the potential for returns over time. Think of your investment portfolio as a financial garden. Just as a garden requires a variety of plants to thrive, your portfolio needs a mix of asset types to grow healthily. This diversification helps mitigate losses, as the underperformance of one asset can be balanced by the stronger performance of another. Well-known individuals with strong investment portfolios. To illustrate the concept of a strong investment portfolio, let's look at some well-known individuals who have mastered the art of investing. Warren Buffett, the CEO of Berkshire Hathaway, is often the first name that comes to mind. Buffett's investment strategy focuses on buying shares of companies that are undervalued but have long-term potential. His portfolio includes significant stakes in major corporations like Apple, Coca-Cola, and American Express, demonstrating a keen eye for value and a preference for holding investments over the long term. Another prominent figure is Ray Dalio, the founder of Bridgewater Associates, the world's largest hedge fund. Dalio is known for his principles-based approach to investing and life. His investment portfolio is characterized by a risk parity strategy, which aims to achieve balance through diversified investments, adjusting the weight of each asset class based on its risk profile. This approach seeks to ensure that the portfolio can withstand market volatility and economic changes. Elon Musk, though more known for his role in founding and leading companies like Tesla and SpaceX, also makes strategic personal investments. Musk's portfolio extends beyond the stock market into private ventures and startups, highlighting an appetite for high-risk, high-reward investments. His success underscores the importance of being deeply involved in and knowledgeable about the sectors where you invest. These examples serve to show that while the composition of their portfolios may differ, successful investors share common traits: a clear strategy, a focus on long-term goals, and an understanding of the importance of diversification. As we delve deeper into how to build your investment portfolio from scratch, keep these principles in mind. Building a strong investment portfolio from scratch. In today's financial landscape, the importance of constructing a strong investment portfolio cannot be overstated, especially when facing the uncertainties of a tough economy. Economic downturns, market volatility, and inflationary pressures can significantly impact your financial well-being. However, a well-crafted investment portfolio stands as a bulwark against these adversities, providing not just protection but also opportunities for growth even in challenging times. The imperative of having a robust investment strategy becomes clear when we consider the dual objectives of preserving capital and capitalizing on market downturns to invest in high-quality assets at lower prices. Such a strategy ensures that your investments can weather economic storms and potentially emerge stronger, benefiting from the eventual recovery and growth phases of the economic cycle. This resilience is crucial for long-term financial planning, whether you're saving for retirement, education, or other significant life goals. To underline the necessity of a strong investment portfolio, let's delve into some compelling reasons supported by data. Historical market trends reveal that while markets do experience downturns, they have always recovered over time and continued to grow. For instance, during the global financial crisis of 2008-2009, the S&P 500 index fell by approximately 50%. However, it not only recovered its losses but also went on to reach new highs within a few years. Investors who maintained a diversified and strong portfolio, or those who took the downturn as an opportunity to invest in undervalued assets, saw substantial returns on their investments in the following years. Moreover, A study by Fidelity showed that investors who stayed in the market between 1980 and 2020, despite numerous economic downturns, would have seen a 100-fold increase in their investment, whereas those who missed the best days of the market due to panic selling or trying to time the market experienced significantly lower returns. This data highlights the importance of having a well-structured investment portfolio that can withstand economic fluctuations and capitalize on the growth opportunities that arise over time. The data and historical trends make a compelling case for the critical role of a strong investment strategy, particularly in navigating through tough economic landscapes. Building and maintaining a diversified portfolio not only safeguards your financial future against unforeseen economic downturns but also positions you to take advantage of the growth opportunities that inevitably follow. It's a testament to the wisdom of long-term planning, disciplined investing, and the value of patience and perseverance in the face of market uncertainties. As we continue to explore how to construct such a portfolio from scratch, keep in mind the significance of these principles in guiding your investment decisions and strategies. What roles do investment portfolio play in worse economy? The role of an investment portfolio cannot be overstated. It acts as a financial lifeline, safeguarding an investor's wealth against the corrosive effects of economic downturns, such as inflation, unemployment, and reduced economic output. A strong, well-diversified investment portfolio is designed to absorb shocks and offer stability amidst financial turmoil. This resilience is crucial because, during economic contractions, many assets, such as stocks and real estate, can lose significant value. However, a diversified portfolio that includes a mix of asset classes, stocks, bonds, real estate, precious metals, etc., can mitigate these losses since not all assets will react in the same way to economic stressor. For example, while stocks may decline during a recession, bonds or gold might hold their value or even appreciate, thus providing a buffer against total portfolio loss. Moreover, in a worse economy, the cash flow generated from certain investments, like dividend-paying stocks or bonds, can provide an essential source of income when other revenue streams may be drying up. This aspect of an investment portfolio plays a critical role in ensuring financial security and flexibility, enabling investors to cover living expenses and avoid liquidating assets at depressed prices. Beyond merely acting as a safety net, an investment portfolio in a deteriorating economy also serves as a tool for capitalizing on unique investment opportunities that arise during such times. Economic downturns often result in undervalued assets entering the market as businesses and individuals sell off investments in a bid to raise cash. For those with the foresight and resources to invest during these periods, the potential for significant returns as the economy recovers is substantial. This strategic positioning requires a robust understanding of market cycles and the ability to maintain a long-term perspective amidst short-term uncertainties. It underscores the role of an investment portfolio not just in defense against economic hardships but also as a vehicle for growth and wealth accumulation. The effectiveness of this approach has been documented in numerous studies, showing that the most considerable stock market gains often occur in the initial stages of economic recovery, highlighting the importance of being invested before the recovery fully takes hold. Furthermore, in a worsening economy, an investment portfolio facilitates strategic rebalancing, allowing investors to adjust their holdings in response to changing economic indicators and forecasts. This active management aspect is crucial for mitigating risks and enhancing the portfolio's potential to generate returns. Rebalancing involves selling off assets that have become overrepresented due to relative value increases and buying more of those that are underrepresented, thereby maintaining a desired asset allocation. This strategy not only keeps the portfolio aligned with the investor's risk tolerance and investment goals but also capitalizes on the buy low, sell high principle, which is fundamental to successful investing. Investment portfolio in a worsening economy is multifaceted, offering both protection and opportunities for growth. It serves as a bulwark against the immediate impacts of economic downturns, providing stability and income when needed most. Simultaneously, it acts as a platform for strategic investment, allowing savvy investors to purchase undervalued assets with the potential for significant returns during the recovery phase. Through strategic rebalancing, it enables investors to adjust their holdings in line with evolving economic landscapes, optimizing their portfolios for both safety and growth. Thus, building and maintaining a strong investment portfolio from scratch is not just about preparing for the bad times but also about positioning oneself to thrive when the economic tides turn. Step by step with facts how strong investment portfolio are built from the scratch. Building a strong investment portfolio from scratch is a systematic process that requires careful planning, discipline, and ongoing management. This journey involves several critical steps, each underpinned by strategic thinking and informed decision-making. Here's a step-by-step breakdown, supported by facts, on how to construct a robust investment portfolio from the ground up. Step 1. Define your investment goals and time horizon. The foundational step in building an investment portfolio is to clearly define your financial goals and investment time horizon. Whether you're saving for retirement, a child's education, a home purchase, or building wealth for its own sake, your objectives will significantly influence your investment strategy. For instance, a study by the U.S. Securities and Exchange Commission highlights the importance of tailoring your investment approach to your goals and risk tolerance. Additionally, your time horizon, the expected time until you need to access your invested funds, plays a crucial role in determining your asset allocation. Those with longer time horizons may afford to take on more risk with higher volatility investments like stocks, which have historically outperformed other investment classes over long periods. Step 2. Assess your risk tolerance. Understanding your risk tolerance is crucial in building a portfolio that aligns with your comfort level and financial goals. Risk tolerance varies from one investor to another, influenced by factors such as age, income, financial responsibilities, and personal disposition towards risk. Surveys by the CFA Institute suggest that investors with a higher risk tolerance are more likely to allocate a greater portion of their portfolio to stocks or stock funds, while those with lower risk tolerance may prefer bonds or money market funds. Assessing your risk tolerance accurately ensures that you can withstand market volatility without making panic-driven decisions. Step 3. Start with a broad asset allocation. Once goals and risk tolerance are established, the next step is creating a broad asset allocation strategy. This involves deciding how to distribute your investments across different asset classes, such as stocks, bonds, real estate, and cash. The concept of asset allocation is supported by modern portfolio theory, which posits that diversification among various asset classes can reduce risk and enhance returns over time. Historical data supports this, showing that a diversified portfolio can smooth out returns, as the performance of different asset classes can vary significantly from year to year. Step 4. Select individual investments. With a broad asset allocation framework in place, the next step is to select individual investments within each asset class. This could involve choosing individual stocks, bonds, mutual funds, exchange-traded funds, ETFs, or other investment vehicles. The key here is to focus on quality, considering factors such as the financial health of companies, for stocks, credit ratings, for bonds, and expense ratios and track records, for mutual funds and ETFs. Research published in the Journal of Finance suggests that diversification across and within asset classes can significantly reduce risk without compromising returns. Step 5. Implement and diversify. Implementation involves the actual purchase of your chosen investments according to your asset allocation strategy. Diversification is a critical aspect of this step, ensuring that your investments are spread across different sectors, industries, and geographies to mitigate risk. The benefits of diversification have been well documented, with studies indicating that a well-diversified portfolio can help investors weather market downturns more effectively than a concentrated portfolio. Step 6. Regular monitoring and rebalancing. Building a strong investment portfolio doesn't end with the initial purchase of assets. Regular monitoring and rebalancing are essential to maintain alignment with your goals, risk tolerance, and asset allocation strategy. Market movements and changes in your financial situation or goals may require adjustments to your portfolio. The discipline of rebalancing, which may involve buying or selling assets to return to your target asset allocation, is supported by research indicating that it can help maintain the desired risk level and potentially enhance returns over time. Step 7. Stay informed and adjust as necessary. The final step in building a strong investment portfolio from scratch is to stay informed about the financial markets and adjust your strategy as necessary. Economic conditions, market trends, and personal circumstances change over time, and your investment strategy should evolve accordingly. Continuous education and staying abreast of financial news can help you make informed decisions, ensuring your investment portfolio remains robust and aligned with your goals. Start investing in strong portfolio. Building a strong investment portfolio from scratch is a journey that begins with a single, decisive step: starting. The importance of initiating this process cannot be understated, especially in today's financial climate where uncertainties abound, but so do opportunities. Embarking on the path to create a robust investment portfolio is more than just a financial decision. It's a commitment to securing your future and potentially transforming your financial destiny. The need for viewers to start investing in a strong portfolio is rooted in several key principles and benefits that underscore the value of early and informed investing. One of the fundamental reasons to start building an investment portfolio is the power of compounding returns. Albert Einstein famously referred to compound interest as the eighth wonder of the world, noting, "He who understands it, earns it. He who doesn't, pays it." The concept is simple yet profound. The returns you earn on your investments are reinvested to generate their own returns. Over time, this process can lead to exponential growth of your wealth. Starting early maximizes the time frame for compounding, effectively allowing your money to work harder for you. For example, an individual who starts investing $10,000 at age 20 with an average annual return of 7% will have over $149,000 by age 60 without making any additional contributions. In contrast, starting at age 40 would yield just over $38,000 by age 60 under the same conditions. This stark difference illustrates the critical advantage of beginning your investment journey as soon as possible. Moreover, investing in a strong portfolio from the outset equips you to better navigate the volatility and uncertainties inherent in financial markets. A well-diversified portfolio, one that spreads investments across various asset classes such as stocks, bonds, real estate, and more, can help mitigate risk while exposing you to a broader spectrum of growth opportunities. Diversification is often likened to not putting all your eggs in one basket. If one investment underperforms, others within your portfolio can offset the losses. In today's global economy, where market dynamics can shift rapidly due to factors like geopolitical events, technological advancements, and changes in consumer behavior, having a diversified investment portfolio is indispensable for both protecting and growing your wealth. Another compelling reason to start building a strong investment portfolio is the need for financial independence and security. Whether your goals include retiring comfortably, purchasing a home, funding education, or simply achieving a sense of financial freedom, investing can be a powerful tool in realizing these aspirations. By allocating resources toward investments today, you're setting the groundwork for future financial success and stability. It's about making your money work for you, generating income even when you're not actively working. This passive income stream can be a critical component of achieving financial independence, reducing reliance on traditional income sources, and providing a safety net in times of economic hardship. As we sign off, remember that the journey to building a strong investment portfolio begins with a single step. Thanks for watching, and here's to your financial success.